This question tests your understanding of flexible budgeting, which adjusts revenues and variable costs to the actual level of activity while keeping fixed costs unchanged. Unlike a static budget, which is prepared for one planned activity level, 100 units in this case, a flexible budget recalculates expected financial results based on the actual sales volume of 70 units. The key steps are: a sales revenue equals actual units times selling price. Variable costs equals actual units times variable cost per unit. A contribution margin equals sales revenue minus variable costs. A operating income equals contribution margin minus fixed costs. Students should remember that variable costs change with activity, whereas fixed costs remain constant within the relevant range. The purpose of a flexible budget is to provide a fair comparison between actual and expected performance by eliminating the effect of changes in sales volume. First, prepare the flexible budget using 70 actual units. A sales revenue equals 70 times $100 equals $7,000. Variable costs equals 70 times $50 equals $3,500. A contribution margin equals $7,000 minus $3,500 equals $3,500. Fixed costs equals $2,000. Your operating income equals $3,500 minus $2,000 equals $1,500. Now evaluate the choices. A. $1,500. Correct. This is the operating income calculated using the flexible budget based on the actual activity level. B. $3,000. Incorrect. This overstates operating income and does not subtract fixed costs correctly. C. $3,500. Incorrect. This is the contribution margin, not operating income. D. $5,000. Incorrect. This represents neither contribution margin nor operating income under the flexible budget. Correct answer: A. $1,500. The flexible budget adjusts for the actual sales volume of 70 units and shows that the company should have earned an operating income of $1,500 after covering both variable and fixed costs. This question examines the advantages of a standard costing system, a widely used management accounting tool for planning, cost control, and performance evaluation. A standard cost is a predetermined estimate of the cost required to produce a product or service under normal operating conditions. By comparing actual costs with standard costs, managers can identify variances, investigate their causes, and take corrective action. Students should focus on the phrase, "except that," which means the question is asking for the statement that is not an advantage of standard costing. Standard costing primarily measures quantitative performance, such as material costs, labor efficiency, and overhead spending. It is particularly useful for budgeting, variance analysis, and communicating cost expectations to employees. However, it does not directly measure qualitative factors such as customer satisfaction, product innovation, employee morale, or product quality unless additional performance measurement systems are used. It assists in performance evaluation. Correct as an advantage. Standard costing allows managers to compare actual performance with established standards and evaluate efficiency through variance analysis. B. Emphasizes qualitative characteristics. Correct answer. Standard costing focuses mainly on quantitative financial measures, such as costs and efficiency. It does not emphasize qualitative characteristics, making this the statement that is not an advantage. C. Permits development of flexible budgeting. Correct as an advantage. Standard costs provide cost behavior information that supports the preparation of flexible budgets for different activity levels. D. Allows employees to better understand what is expected of them. Correct as an advantage. Clearly established standards communicate expected levels of cost and operational performance, helping employees understand performance targets. Correct answer. B. Emphasizes qualitative characteristics. A standard costing system is valuable for cost control, budgeting, variance analysis, and performance evaluation, but it primarily measures quantitative efficiency rather than qualitative aspects of performance. This question tests your understanding of the flexible budget cost formula, an important concept in budgeting and cost behavior analysis. A flexible budget adjusts expected costs and revenues to different levels of activity, making it more useful than a static budget for performance evaluation. The key point is that variable costs change in proportion to activity, so they are expressed on a per-unit basis. In contrast, fixed costs remain constant in total within the relevant range, regardless of the activity level. Understanding this distinction is essential for preparing flexible budgets and analyzing cost variances. Students should remember that a flexible budget recalculates total variable costs by multiplying the variable cost per unit by the actual level of activity, while leaving total fixed costs unchanged. A. Per unit and fixed costs are stated in total. Correct. Variable costs are expressed per unit of activity because they vary with production or sales volume. Fixed costs are expressed as a total amount because they do not change within the relevant range. B. In total and fixed costs are stated per unit. Incorrect. Variable costs should not be stated only in total, and fixed costs are not normally expressed per unit because the fixed cost per unit changes as activity changes. C. In total and fixed costs are stated in total. Incorrect. While fixed costs are stated in total, variable costs must be expressed per unit to allow the budget to adjust for different activity levels. D. Per unit and fixed costs are stated per unit. Incorrect. Fixed costs are not stated per unit in a flexible budget formula because their per unit amount varies with production volume. Correct answer. A. Variable costs are stated per unit and fixed costs are stated in total. This format allows the flexible budget to adjust accurately for different activity levels while recognizing that fixed costs remain constant in total.